From New York City, for our viewers worldwide, I'm Matt Miller in for Jonathan Farrow. We have futures rising as window dressing pushes the S&P 500 over 4,400. The countdown to the open starts right now.
Everything you need to get set for the start of U.S. trading. This is Bloomberg, the Open, with Jonathan Farrow.
Coming up, U.S. inflation cooling as consumer spending stalls, sending futures higher and Treasury yields lower. As Big Tech closes in on its first half of a record, we'll begin with the big issue, though, wrapping up a wild 6 months in the markets.
First half of the year.
The global economy has held up a lot better in this first half of the year.
The economy is pretty robust.
Markets now need to contemplate what the future holds.
If we look at what's driven the S&P 500 this year, obviously it's been this outperformance in a handful of growth stocks.
We're actually starting to creep back towards overbought territory.
We're going to be in an environment where central banks will have to hold tight.
Central bankers are still focused on the inflation picture.
We are looking at a new interest rate regime moving forward.
I think it's a relatively hawkish message still.
Uncertainty, volatility for the markets.
Massive chess game, geopolitical chess game.
Uncertainty on the Russian side.
China risk is rising across the board.
Cracks under the surface.
We're going to get a recession next quarter.
Whatever this is, whether it's a recession or a growth scare, I do think it's starting.
We are slowing, there's no doubt about that.
We're very cautious.
Joining us now to discuss is BNP's Yelena Shulyadeva and Larry Adam of Raymond James. Yelena, I'll start with you. It has been a really data-heavy week. We got a surprise jump in GDP, but very backward-looking, right, for the first quarter. We've just got inflation numbers out that are a little bit lower, but still consistent with what we've been seeing in the core in terms of PCE, 4.6%. As consumer spending stalls, what's your outlook on where we are right now in the economy?
So let me just comment on GDP revisions from yesterday, Matt. I think that was quite significant, even though the third estimate is usually not that important. I think what we saw in the numbers is an upward revision in services and some downward revisions in imports. So taken together, that means slower momentum going into the second quarter, because in order to achieve the same rate of growth in services that we saw back in the first quarter, you really need strong services spending. And today's data told us that, well, it's not that strong anymore, because we did see a little bit of a decline even in real spending, which rounds up to zero. But still, I think there's a significant slowdown in consumer spending going into the second quarter, and the downward revisions in imports actually supporting this notion.
You know, that
so going forward, go ahead.
I just want to say that gets to this debate, Elena, about excess savings, right? The Fed just put out a paper out of Washington, D.C. that says excess savings are gone right now. The consumer doesn't have any more of, the stimmies that were handed out over the first couple of years of the pandemic. But the San Francisco Fed a couple weeks ago said we still have enough to last the consumer through the end of the year. What do you think?
We're a little bit in the second camp, so we think that there's still a little bit left there, and we're kind of thinking maybe by the end of the year we'll be out of excess savings. But if you look at the data, that is kind of like telling us that we are probably getting close to exhausting those excess savings. The savings rate, which is just a monthly indicator of how much we earn and how much we don't spend, right? That is creeping higher. In today's numbers, we saw a 0.3 increase in the savings rate. And that is telling me, that consumers are feeling a little bit more cautious about, spending and really splurging on goods and services.
Larry, what do you think? I mean, it does look like the economy is stronger than had been expected with those GDP figures. But, if the consumer runs out of the fiscal injection that it was given, we could drop off of a cliff edge.
Well, I don't think we're going to fall off of a cliff. I do think that the consumer is a little fatigued. I agree that those excess savings are probably going to be evaporated by the end of this year. I think just as important, though, these borrowing costs are starting to put a bite on what consumers are willing to take when it comes to increased debt burdens. Because if you look at consumer loans, if you look at auto loans, they are starting to decline. And then I think the third thing is that as we get further into this year, I do think that job growth is going to slow quite significantly and actually turn negative. And I think that sets us up for a mild recession during the fourth quarter of this year going into next year. But I want to stress that I think it's going to be mild. And the reason I say mild is that I think it'll last just 6 months. I think the ultimate amount of GDP growth that'll be subtracted will be less than 1%. And I think the job losses are going to be less than 1 million. And historically, we lose about 2.5 million jobs during recession. So I think it's going to be mild.
Well, does that mean you move into fixed income with this surge in rates?
Well, two things. First of all, it's interesting as we're sitting here right now, we just hit our target on the S&P 500 for 4,400. So clearly we're a little bit more cautious on the equity markets going forward. I don't think that this is the end of the bull market, though. If you look out to our 12-month forecast, we think it's 4,600 for the S&P 500. To your point about fixed income, we do like fixed income. I think the 10-year Treasury yield will go down to about 3.25 by the end of this year, and that sets up some capital appreciation for longer-term bonds.
All right, Larry and Yelena, sit tight. I want to get over to Katie Greifeld right now because after a year marked by steep losses, 2022, the message halfway through 2023 is clear. Big tech is back. Leading the gains within U.S. equities, the Nasdaq 100 adding $5 trillion in market cap. Katie, what do we got?
The best first half on record for the Nasdaq 100. We're talking gains of nearly 37%. The S&P 500, a broader index there, up about 15% or so, in a performance that no one really expected. Remember, at the start of this year, Wall Street was calling for pretty much a flat market. That's not what we're getting. Let's look at the sectors that's leading it there. Of course, we have to start off with technology, up nearly 37%. Communication services, too. A lot of the names that we call tech in that sector up about 34%. Consumer discretionary also rising more than 30%. And we have to throw the socks on there because the semiconductors, what a run. That Philadelphia Semiconductor Index up 43% or so. At the bottom, which we're not showing, is the energy sector. Of course, that's been the disappointing, the loss leader after solid outperformance over the past 3 years. And if you look at commodities, it shows why. Not exactly painting a rosy picture for growth. You can see agriculture, industrial metals, and energy broadly all down double digits and then some. But let's talk about the bond market because this is fascinating to me. If you look at the year-to-date range, it's about 75 basis points this year. And there's a lot of division as to where we go next. Of course, we heard from former Fed President, New York Fed President Bill Dudley yesterday writing that he could see the 10-year go to 4.5%. Then actually, Matt, we just heard from Larry Adams saying that we could go to 3.25. So it's a really hot debate where the bond market goes and where Fed policy goes in the next 6 months.
Yeah, absolutely. Katie, thanks very much. Katie Greifeld talking to us about the record jump for the Nasdaq 100 in the first half. And I want to get back to our panel here. Larry, what's your take on the big tech run that we've seen? It still has legs, and a lot of the other things we expected in the first half didn't come to fruition. We didn't see a drop in the dollar. We didn't see a rally in commodities. Did we get everything wrong at the beginning of the year?
So a couple of things. First of all, I still do like big tech. I think it's important to put it in perspective, right? It was one of the worst performing sectors last year, so much of it was a bounce back. I do believe in technology continuing to reinvent itself, and obviously with the latest addition being AI, that'll continue to drive earnings. And I think that's important because when you hear a lot of investors say that tech has gotten expensive, I'm not necessarily sure that's the case because tech is one of those sectors that consistently beats on its earnings. And if you start to factor in the eventual beats, I think that it's not as expensive as what's priced into what people think the PE is today. As far as this market, there are a lot of people that got the first half of this year wrong. And Fortunately for us, we were much more optimistic. I think a lot of the catalysts that everybody was talking about during the first half of this year actually proved to be positive. I think coming into the year, we all knew that inflation was going to go lower. We knew that the government wasn't going to default on our debt. We knew the Fed wasn't going to continue with 75 basis point increases. So I think a lot of people got nervous, and that's one of the reasons why we were so optimistic coming into this year, because everybody was so pessimistic. But now I think we've had a 180-degree change on that, and that's why we're a little bit more cautious, because everybody's kind of joined that uber bullishness camp.
All right, I want to get to Yelena right now on the rates question. J.P. Morgan ditching their bullish stance, distancing themselves from the long duration call on treasuries, writing we can no longer justify our tactical long duration view as data have continued to surprise to the upside. Treasuries continue to look too rich to their underlying drivers, even after this latest move. An investor position suggests heightened risks of long liquidations. As such, we unwind our tactical longs in 5-year treasuries. We've heard from Larry. We heard from Bill. Yelena, what's your take on rates?
Well, look, there were a lot of things that did not realize in the first half of the year, and people were expecting a recession to hit in the first half of the year. We were not in that camp. We're actually expecting a recession right now. So there's a lot of reversals are happening right now. So the data is still solid, but going forward, we expect quite a steep decline in activity, and in terms of payrolls as well. So we think that we may see a little bit of payrolls strength in the coming couple of months, just simply based on the seasonal adjustments. But going forward, we would not exclude any negative readings. So we could see some dramatic shifts going forward.
All right, Larry, Adam, and Yelena Shulyadeva, stick with us. I want to get to some single stock stories right now ahead of the opening bell. For that, we go to Abigail Doolittle. Abby?
Let's start out with the big one, Matt, and that, of course, is Apple. Right now in the pre-market, it has crossed that $3 trillion market cap level, leading, or a piece of the big tech from a point basis for the S&P 500 and the Nasdaq 100, certainly leading this year's charge. 190.74 or higher. That is the level to watch for a $3 trillion market cap on Apple. Carnival up 3.4%. We have Jefferies upgrading shares to a buy from a hold. They also have a street high price target of $25. And if you recall, they reported earlier this week, the stock fell a lot. But over the last 4 days of this week, Matt, we now have the stock up about 8%. So net, that report has been digested as a positive report. And then Nike, not so much. They missed a messy quarter. The outlook, not great. China is a bright spot, but nonetheless, the stock is down after a disappointing earnings report, and more so, again, the outlook.
All right, Abigail, thanks very much. Abigail Doolittle talking to us about the impending $3 trillion stock coming out of Apple. Coming up, U.S. inflation starting to cool.
We're seeing disinflation. The 3 waves of inflation that we've had, the demand shock after the pandemic, the supply shock of the war, and then the profit-led inflation. Wave 1 and wave 2 have gone.
That conversation coming up next. This is Bloomberg.
We're seeing disinflation. The 3 waves of inflation that we've had, the demand shock after the pandemic, the supply shock of the war, and then the profit-led inflation. Wave 1 and wave 2 have gone. The disinflation narrative is going to start to become a bit more established.
U.S. inflation cooling, consumer spending stalls. Atlanta Fed President Raphael Bostic weighed in on the road ahead.
I think it's wise that we take some time to assess how monetary policy tightening is affecting the economy. Because in my view, policy has been truly restrictive for only 8 or 9 months. It is less certain that we need to keep hiking the policy interest rate in the immediate term, lest we risk tightening too much and draining too much momentum from the economy.
Bostic turning out to be the dove we love. Bloomberg's Michael McKee joins us now to talk about the data drop we just got. Mike, it did look like inflation's cooling, but not that much, and still the core is at the level that we've seen it pretty much all year.
Yeah, kind of sticky prices, particularly in the core for PCE. These are the numbers that the Fed watches closely, its favorite inflation indicator. Also, they're watching what's happening with consumers. And as you mentioned, Matt, consumer spending has dropped off. It was up 0.6 in April, only up 0.1 in the most current month, the May numbers that we're getting now. Most of that on services, much less on goods, but still, it does show maybe the Fed is having an impact. Personal income was stronger, and a lot of that was wages and salaries, which is something the Fed has been watching closely. 0.5%, the most since January. And there you can see the numbers for PCE headline and core. Year-over-year numbers is what people are kind of focused on. 3.8% is the first time that we have dropped below 4% since the pandemic. But you mentioned that core, and let's take a look at where we are with the core and the core services ex housing. That's Jay Powell's favorite indicator. And as you say, we're kind of being stalled out here. Core services ex housing about 4.5% on the month. Looking ahead to next week, which is what we have up on the screen right here, we have ISM on Monday, and so some of us are going to have to work. Tuesday, you can watch the fireworks, and then we end the week with June jobs. Jobs is going to be the next big number to watch, so we'll see if that one comes in with some weakness. I guess that's what we're looking for now. Weakness, not bad, not drops, but something a little bit weaker, as we got with it's the spending numbers today.
Is that what, by the way, you know, I'm obsessed with bank balances and excess savings because I want to know how much the consumer has left to power this economy. There's a debate as to whether, you know, the consumer has anything left, but the consumer still has jobs, right? Does that keep us from falling off a cliff?
It does. People spend what they make. And so as long as the jobs picture is pretty good, that keeps the money flowing into the pipeline. But interestingly enough, the savings rate did go up significantly in the month of May to 4.6 from 4.1%. So we are seeing people still with reasonable bank accounts.
All right, Mike, thanks very much. Mike McKee walking us through the data we got at 8:30. Larry, Adam, and Yelena Shuliatyeva are back with us. And Larry, what do you think of, you know, rising credit card debt, rising delinquencies on auto loans? I mean, the consumer, even though he looks pretty healthy, seems to be stretched on some measures.
I do think that they are stretched, and I think that's one of the reasons why we think we go into a mild recession in the fourth quarter of this year. I think the one good thing that really came out of that report today, though, that I think the Fed should keep a close eye on is that if you do look at real wage gains, they've actually been positive 10 out of the last 11 months. And I think that that's a positive because one of the things that the Fed is fighting is inflation expectations. So as long as you're making more than what inflation is going up, I think that's a positive thing. And I think that's something they should keep an eye on. But I think that report this morning was very good. Spending is slowing. Inflation is coming down. We know that services is continuing to be higher, but during the second half of this year, whether it's rental prices coming down, a lot of the costs when it comes to travel and leisure going lower after we come off what we call the summer of travel revenge 2, I think that'll give the Fed more cover to stop this tightening cycle before it gets overdone.
Yelena, what do you think on the Fed tightening cycle? I mean, Powell has been pretty consistent in his message to the market, even if Mr. Market doesn't want to believe him. Do we really get 2 more hikes?
We are in a one more hike camp. We think the July rate hike will be the last one of the cycle. And Powell, despite, you know, him saying, oh, 2 more hikes is what the majority of the FOMC is expecting, I think he strongly hinted that they are ready to move more slowly, like at every other meeting. So that was the message to us from his recent communication. So that means July is when they hike, and then they will take another pause. And by the time they get to November, it will be just too late to hike rates because the economy will slow down and we will probably see negative prints on the labor market.
You know, Larry, if I look at the equity market on a matrix, for example, we can see that obviously communication services, technology, telecoms have been leading the charge, and everything else has been a loser. Banks are starting to come up into the into the improving quadrant, if you will, but everything else has been down. Do you think we're going to see a broadening of this rally? Does everything else come up?
I do. I think you will see a broadening, a couple of sectors that I think that have positive catalysts in front of them. If the Fed does end its tightening cycle, I think that'll be a positive for the financial sector. Plus the fact that what you've seen that they are in good shape after the stress test, to me, that's a positive for that sector. If you look at the energy sector, yes, oil prices have been depressed. They're now below $70. We actually think they move higher by the end of this year, closer to $85 per barrel. That'll help that sector do well. And then our other favorite is healthcare. And if you've done anything in the healthcare field, you still have a significant backlog. I think that's good for visibility and earnings. I think that's a sector that will continue to do well for the remainder of this year. So I do think you're going to see a broadening out. And I think the ascent of technology will slow as we go into the second half of this year.
Let me get, Yelena, your take finally on oil and the commodities that Katie walked us through. They've done so poorly. In fact, WTI is on track for back-to-back drops, quarterly drops. I think Brent is on track for 4 quarterly drops, which would be its worst record in 30 years. Why haven't we seen support for these commodities?
Look, the economy is slowing. There's some international developments happening as well. And that is not a bad thing for the U.S. economy, which will help the consumer, I think. So at 10 o'clock, we'll get another reading on inflation expectations from the University of Michigan. And I think, as long as inflation expectations remain, contained, and that's what we probably will see on the back of all this, commodity data. I think, the Fed will be, it will be easier for the Fed to pause and eventually stop the tightening cycle because they're watching those indicators closely. And that will help, the consumer, and that will help the economy to go through a milder recession rather than a severe one. So I agree on that front.
On that point, you agree. Yelena, thanks so much for joining us. Yelena Shulyadeva and Larry Adam, really appreciate you joining us today. Coming up, the morning calls. And later, Keith Lerner of Truist joins us as investors close the book on the first half. That conversation still ahead at the opening bell. This is Bloomberg. Time now for our morning calls. Jefferies upgrading Carnival to a buy, highlighting the company's strong leadership. Citi starting Apple with a buy rating, expecting gross margins to keep improving. And Bank America cutting its Nike price target to $125, seeing uncertainty in North America. Coming up, Keith Lerner of Truist joins us for the opening bell. This is Bloomberg. This is the countdown to the open. I'm Matt Miller in for John Farrow. We're looking at futures higher. Nasdaq futures up more than 1% after already the strongest first half forever for the big tech index. One stock to watch at the open is Apple. We could see it hit $3 trillion in market cap. There's the bell. Let's switch up the board a little bit and see what's going on across assets. The euro, it looks like at 109.07, gaining a little bit of ground against the dollar. The 10-year yield coming down, but still at 384 after a huge jump yesterday. NYMEX crude finally up over $70, but even with this gain, it's looking at a back-to-back quarterly drop, the first time we've seen that since 2019. Let's get back to Apple. That's the stock we're watching, closing in on a $3 trillion market cap, a feat no other company has ever achieved. D.A. Davidson's Tom Forte weighing in earlier on surveillance.
When you think about the march to $3 trillion, it's mainly been on the back of the iPhone. The iPhone continues to perform very well. But when you think of the next trillion and you think of Vision Pro and augmented reality and virtual reality, there are a lot of structural challenges even for Apple.
Joining us now with more is the co-host of Bloomberg Technology, Ed Ludlow. Good morning to you in San Francisco, Ed. So it's a big round number that doesn't necessarily mean anything exactly, right? But it's still an historic moment.
You cover the technology sector. Apple, the first company to touch $3 trillion of market cap. It is a big moment. I think we'll go later in the show, and there you have it. Apple hitting $3 trillion of market cap, the first global stock to do so, to have $3 trillion of market capitalization or market value. $900 billion of market value added to this stock year to date. We're up more than 45%. It's the first time we've been near this mark since the beginning of 2022. And then what happened? The stock fell 26% last year in 2022, trading at 191.82. What we hear time and again, Matt, on Bloomberg Technology is kind of what your guest in that soundbite just echoed. It's the predictability of earnings. It is the sheer volume of sales when it comes to the iPhone, not so much the Vision Pro and the headset, and we can talk about that later. But interesting to read the notes that have been out there in recent days. Everyone goes to all the old school stuff, the balance sheet and the shareholder returns profile, which isn't as fun and exciting as the tech sector normally is. But I would say this is a big moment, at least for me.
It's also a company that has never paid a big dividend. They do gigantic buybacks, but that's not as reliable. Why do you think that these big tech companies and most of the mega cap techs that you cover don't pay dividends?
It's a great question. The buyback is the preferred modus operandi for shareholder returns. I think, the question with Apple specifically is why sit on this ginormous cash balance? The M&A picture right now is murky. Think about all the writing we've done about Lina Khan and the FTC in particular. As soon as Bob Iger went on stage at WWDC the other day, the rumor mill started again about the hypothetical of Apple buying Disney. In this environment, could you imagine that? But that's usually the criticism, that if you're not doing a dividend, you are doing buybacks. What is all that cash for? What's the point of it, other than having a pretty robust Treasury department, I imagine?
All right, Ed, thanks very much. Ed Ludlow there, co-host of Bloomberg Technology, talking to us about this historic moment, Apple becoming the first $3 trillion market cap company of all time. Now let's talk about Nike, disappointing investors with its annual outlook despite an improved performance in China. Global Data Retail saying, quote, overall, Nike is a solid brand and it's not suffering from an existential crisis. However, it isn't on the front foot either and has to accept that the year ahead will be one of resetting, retrenching, and reformulating the way it does business. Joining us now is Bloomberg's Abigail Doolittle to go through the numbers. Abby?
Well, yeah, there is a bit of tension here for Nike, given the fact that they did beat on sales for the quarter that they just reported. They missed earnings a little bit. In China, a bright spot, but the real drag on the stock right now, having its worst day in about 10 days, is what you talked about, cutting the outlook for the full year. So it's a little bit of a messy situation there. And in fact, Barclays is saying that in terms of the full year outlook, it's not that it was just a miss. It was also because analysts were expecting it to be lower. It was at the lower end of the expectations. And that might be setting up this quarter that we're going to see companies perhaps in terms of the outlook just a little bit less than what folks are looking for. Piper Sandler is saying that the China performance was overshadowed by the fourth quarter earnings pressure and also this soft guidance that the brand affinity remains strong. And so there is this idea that Nike, of course, is Nike, and so folks will flock to it, but that they do have to do some resetting here. And also with gross margins, that's where the pressure came in terms of the earnings miss. So Nike under a little bit of pressure today right now, actually going down towards session lows, Matt.
I saw, by the way, Abby, a report from a European soccer club a couple of days ago that 82% of female soccer players they surveyed have foot discomfort because there still aren't soccer cleats or football boots, as Farrow would say, that are specifically made for female feet. It shocks me that this company, which tried to start selling more shoes to women decades ago, still hasn't developed that kind of technology.
That's interesting, Matt. Nike, I would say, has a more narrow footbed, so you would think that they would be able to develop that. I don't know. Maybe that's up to Hoka, which I would have to say those sneakers are kind of the rage right now because there's so much comfort there. But yeah, maybe that's an opportunity for Nike to consider as it is redoing itself just a little bit this year.
All right, Abby, thanks very much. Abigail Doolittle talking to us about Nike. Now, Wall Street is diverging over the fate state of corporate profits. Morgan Stanley's Mike Wilson sounding the alarm, writing, quote, "The headwinds significantly outweigh the tailwinds, with risks for a major correction rarely higher. We believe the next leg will be about deteriorating pricing and top-line disappointments." Joining us now to give us his take is Keith Lerner over at Truist. And Keith, it's, I think, a fascinating setup for second quarter earnings, because we expected a drop of 8% in Q1 and beat considerably with earnings falling on the profit side only 3%. Now we're looking for an 8% drop in Q2. How do you think the S&P 500 companies are going to deliver?
Well, first, great to be with you, Matt. Yeah, I think that is an important question. And one of the reasons why the market has held up, I think, better than a lot of us had expected in this first half is earnings have held up better. Our point of view is that earnings will likely continue to do fine. I don't think it's going to be a blockbuster at this point. But one thing we kind of changed our view back in March when we upgraded tech is tech. Tech's the biggest part of the overall market. And we all know tech earnings were actually weaker than the overall market last year. So what's changed? This year, we're seeing the earning trends for tech, the biggest component of the market, move up on an absolute and a relative basis. In our view, even if the economy slows down later this year, which we still expect, companies will need to continue to spend on tech or fear being left behind. So we think, the big, earnings declines that some fear is less likely because of that.
Who do you think is going to be, who will be the leaders and the laggards, Keith, in this earnings season?
Well, listen, to be fair, I think the expectations are somewhat high, obviously, relative to when we came into the year. So it'll be more divergent even within sectors. I think tech will continue to do well on the earnings front, as we mentioned. Listen, stocks are likely to consolidate after this big first half, but I think tech is likely to continue to be leadership. And the other area that, that we like is industrials. I think industrials benefit from not only the defense spending that will continue, but also, a lot of these infrastructure bills and so forth. There's this spending that's going to continue to creep into the overall market. So I think industrials will continue to do well. And those are two of our favorite sectors still as we move into the second half.
If you look at 2024, and let me actually pull out some sound from Mona Mahajan, Keith. Listen to what she told us about her look at next year's earnings.
When we think about 2024, we see better earnings forecasts ahead. We think earnings will rebound. We see better inflation metrics ahead. And we see a Fed that has told us it's not only stepping to the side in 2024, it'll start cutting rates as well. So that backdrop seems more promising to us.
She's referring, of course, to the cuts evident in the dot plot. Keith, how do you think we set up for earnings next year?
I think, I actually think they will continue to be more moderate. I think the big picture, even kind of thinking about how earnings play into the overall market, we don't think this is a runaway bull market, even though it's felt like that here in the first half, because, as we look at today, the S&P is trading at around the 19 multiple. So it's already embedding some pretty good expectations that earnings are going to be fine for next year. The other thing, Matt, I think it's important is we're going to have more policy constraints. Like right now, the market is moving up based on better economic numbers. But at some point, they're going to focus on what this means for the Fed as well. So I think earnings, are they going to be 5, 6, 7% next year? That's fine. But I guess the question becomes how much upside or what kind of multiple are you going to put on that at this point? So we think you have to respect the trend. We think beneath the surface, there's relative opportunities. We upgraded stocks early last month, but we see more opportunity in something like the S&P Equal-Weighted Index, which had the biggest underperformance over the last 30 years relative to the big cap index. But again, from the overall market, it's tough to see huge gains from here based on starting points.
All right. Awesome to get your take, Keith. Thanks so much for joining us. Keith Lerner is going to stick with us, but I want to talk coming up about Apple hitting the big $3 trillion milestone.
I think that a lot of the good news is already priced into the stock. So when you think about the march to $3 trillion, it's mainly been on the back of the iPhone.
More on Apple, that conversation coming up next. This is Bloomberg.
When you think about the march to $3 trillion, it's mainly been on the back of the iPhone. The iPhone continues to perform very well. But when you think of the next trillion, and you think of Vision Pro and augmented reality and virtual reality, there are a lot of structural challenges even for Apple.
Let's get back now to our really stock of the day. The first company ever to reach a $3 trillion market cap and surpass it. Citigroup is expecting these gains to continue. The analysts there see upside of another 30%, writing, quote, "The street is underestimating the potential for continuing gross margin expansion as it navigates the macro slowdown and inflationary pressures." Bloomberg's Ed Ludlow joins us again with more on, Ed, again, this historic moment.
Yeah, it's really interesting because which factor is most important here? You know, that Citi note that the gains will continue is interesting. You look at RSI, Relative Strength Index, we're at 75. Anything above 70, you're in overbought territory. How much do we emphasize the technicals? I go to Mark Gurman's Tech Daily column. This has very little to do with the Vision Pro and everything about the iPhone. And I think that's been echoed by a lot of our guests here on Bloomberg Television, particularly on Bloomberg Technology. You know, the Vision Pro is really exciting. I was there at WWDC getting my hands on it. But the reality is that it will be a few $1 billion of sales in the first year, maybe. iPhone last year, $200 billion. And with the iPhone and Mac comes this ecosystem that includes higher margin software. And a lot of the emphasis from the street seems to be on the latter point.
You know, the driver that we've seen for big tech, or one of the main drivers, Ed, has been AI. I don't have to tell you, you talk about it every single day on Bloomberg Tech. How much does that push Apple higher?
You know, they've been restrained in how they talk about artificial intelligence. You know, I'll never forget that week of earnings where all of the mega caps reported. Alphabet, Microsoft, and Meta all go just full send on their AI prowess. And Tim Cook was much more measured, talking about how machine learning in particular has always been a function of iOS. They're excited about AI, but it's been muted for them. I think, you know, separately, what we want to know is on the AI and ML side of things, if we are going to have a next generation of augmented reality hardware, how their competence in that field improves the processing and also content slate. What you can literally do with Vision Pro. Has it fed into the Apple story? Not as much. The other thing's the macro picture. You know, Apple, again, go to the balance sheet, the predictability of its earnings. When we worry about those kind of things, it acts almost like a haven name at times, which is so interesting given the AI hype of the last 6 months.
All right, Ed, thanks very much. Ed Ludlow, their co-host of Bloomberg Tech. You can catch his program in just about 2 hours' time. Let's stick with tech, but broaden it out a little bit. The Nasdaq 100 closing in on its best first half ever, jumping more than 35%, adding more than $5 trillion in market value in the first 6 months. Bloomberg's Katie Greifeld is back with us for more. Katie?
Well, the Nasdaq 100, it's taking a victory lap this morning. That index currently up about 1.3%. And when you think about the first half, let's talk about the sectors. We talked about this a little bit at the top of the hour. Infotech has been the dominant outperformer so far this year, up over 40% at this moment, really climbing just in the last hour alone. A lot of that is thanks to Apple. You can see consumer discretionary as well as names that we often call tech. I'll get to that in just a moment. And the chips, of course. The theme here is AI. That's the common denominator between a lot of these names. And let's look at the specific names that have been driving this rally, because there's really 7 of them that have been the absolute heavyweights. Of course, Apple is up there in terms of its market value that it's added to its market cap, over $900 billion. That takes us to $3 trillion this morning. Microsoft, Nvidia, Amazon, of course, are there as well. Tesla, Meta, Alphabet, those are your 7 that have really been powering this rally. And again, a lot of the names there that we think about as tech are actually discretionary. I will point out, Matt, also on track for its best opening half ever. That sector up 30%. That's the likes of Amazon. It's the likes of Tesla.
All right, Katie, thanks very much. Katie Greifeld there. Catch her later on this afternoon when she anchors Real Yield at 1 p.m. Let's get back, though, to the AI frenzy continuing. Some say it will be the next big catalyst in the tech sector.
AI is the real thing. It's not going to ultimately be about the tech makers. It's going to be about the tech takers. It may be the companies that implement generative AI to truly disrupt and transform and creatively destroy and reinvent their business models.
Truist expecting big tech to continue to outperform as well. Keith Lerner writing, quote, at the sector level, we still see technology and communication services as longer-term leadership and remain overweight. I'm pleased to say Keith is still with us. And Keith, how much more can these big tech stocks outperform without the broader market catching up?
Well, in our view, we think the average stock will start to do better, and in our view, we're likely to see some consolidation of these big gains. But it's hard to bet against big tech. I mean, because we can talk about valuations, but the reality is tech tends to outperform based on how earnings are doing relative to the overall market. Valuation, at least on a short-term basis, doesn't really help you a lot. You know, the other thing, Matt, that I'm looking at this morning, you know, last year there was a lot of discussion about when interest rates went up, that tech would underperform because they're long duration. That's not happening this year. Why is that not happening? Because markets are more focused on the earning trends. And then there's a lot of discussion about Apple. Now, I'm not here to recommend individual stocks, but on a technical basis, the stock just broke out of an 18-month base. So it's hard to really try to top tick this. And we don't think this is, you know, 2000. I mean, valuations are rich for the overall technology sector, around 27 times. That's about half of what it was during the, the tech bubble peak. And even as we look at returns, tech's up about 32% over the last year. Remember, we had this kind of round trip. But back in 2000, heading into the tech bubble, we were up over 100%. So what's different about today is the biggest companies are almost the most profitable, and those earning trends are still relatively strong. And it's hard to see that changing.
Yeah, in fact, that's an argument for the S&P weightings. These giant companies, even though they take up more of the index, they're offering sustainable profits. On the other hand, Keith, you mentioned the equal weighted index. I pull up a chart of the equal weighted index versus the S&P normalized to the beginning of the year, and we can see it's starting to catch up. The red line here is just to denote when we saw the regional banks crisis. We've climbed back above that with the stress tests. And I wonder if you think we're going to see equal weight do even better relative to the S&P.
I think on a short-term basis, that's likely to continue because, remember maybe about a month ago, people were comparing saying, hey, Apple is now bigger than the entire Russell 2000. If you have some money that even just kind of moves out of tech on a shorter-term basis, it can have a big impact on the rest of the overall market. The other thing, I think a lot of folks are underinvested right now. They don't want to necessarily chase tech, so they're looking at other opportunities, including institutions. And I think the average stock will benefit. The biggest sector in the equal weight index is industrials. And also the S&P equal weighted index is trading around the 15 multiple. Now that's not cheap, but it's pretty reasonable relative to the rest of the market. So we do think there's more catch up to go, especially after you had the worst 3-month performance since at least 1990. The rubber band got stretched too much, so we think there's some catch up and further to go here.
I kind of smirked when I said, Keith, some say that AI is going to be the next big driver for tech. Clearly, it already is. And I don't think anyone doubts it's going to be a revolution on the same level as the internet or the PC. What's your take on AI?
Well, I think it is going to be revolutionary. But the one thing, I was a young analyst in the 90s, and one thing that you learned about going through the technology bubble is, who you think the winners and losers are going to be can really change over time. And let's even think about the poster child of the technology bubble, which was Amazon. Amazon, if we forget about this, but the stock after the bubble was down 78%, but it came to be one of the big beneficiaries. So I think it's real. I think there's still a lot of unknowns about who the actual winners and losers will be. I think short term, the obvious ones, the big cap tech, some of the chip names that we know are benefiting from that. But it's also going to be what industries leverage AI to become more efficient and more profitable and hold margins up. And again, I think we can speculate about that, but there's a lot of uncertainty. The broader trend, though, is going to have a significant impact, and it already is starting to show up.
All right, Keith, thanks so much for joining us. Pleasure having you here. Keith Lerner from Truist. Coming up, the market-moving events you need to be watching. That's coming up next in our Trading Diary. This is Bloomberg. Time now for the Trading Diary. Here's what you need to be watching. Next week, the UMich Sentiment Survey coming out at the top of the hour. Well, that's today. But next week, U.S. markets are closed Tuesday for the 4th of July. We'll get Fed minutes on Wednesday, initial jobless claims on Thursday, and then finally the granddaddy of all economic statistics, the U.S. payrolls report on Friday. This is Bloomberg.